Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. One of the toughest and sometimes most emotional decisions you have to make as an investor is when to buy or sell a stock. This can be a really tough decision because in the short run, the market is a voting machine. Ben Graham said this when he was describing how stock prices are often driven by investors' emotions and knee-jerk reactions any given year. We've seen some of that recently as growth stocks have been heavily in favor and investors have eaten up the early narrative around AI. It can be really easy to get swept up in these types of frenzies, especially when easy money is being made on the way up. But in the long run, the market is a weighing machine. This means a company's fundamentals win out and drive a stock's valuation. In today's video, I'm going to share with you a simple framework I use to value dividend stocks. It's rooted in the idea that stock prices follow earnings and dividends over time. We can see that relationship in this chart, which plots Johnson & Johnson's share price in blue against his quarterly dividend payments in orange, going all the way back to the year 2000. There are numerous periods where J&J's stock price declined or stagnated, but the pharma company's dividend marched higher every year, reflecting Johnson & Johnson's rising earnings power and growing intrinsic value. Now, the stock price didn't always acknowledge J&J's rising value, but the company's increasing dividend put upward pressure on the share price over time, and they eventually converge. For more proof of this relationship, we can go back to high school stats class and run a regression analysis, which is basically a statistical method that helps you quantify the relationship between two or more variables. This scatter plot looks at what J&J's stock price was at the time of each of its quarterly dividend payments going back to 2000. When we plot a regression line through the data, we get an R-squared value of 0.9, which means that 90% of the changes in J&J's share price over this period can be explained by changes in the quarterly dividend. Now, this correlation does not necessarily imply causation, but I would argue there's a strong relationship between dividends and share prices for many companies just like J&J because their rising dividends are a reliable measure of their earnings power, their financial health, and their long-term growth prospects. As long as those factors remain steady, we can make a reasonable guess about what J&J's shares are worth based on its dividend and where it is headed. On our website, Simply Safe Dividends, we have a valuation tool that does this work for us. After logging in, I'll pull up Johnson & Johnson's company page to show you an example. So if you're unfamiliar, Johnson & Johnson is a mega cap healthcare stock. The business is somewhat balanced between branded pharmaceuticals and medical devices, although the pharma side has much higher margins. The company is a dividend aristocrat and king. It's paid higher dividends every year since I believe it's 1963, over 60 years of rising payouts and over 100 years of stable or rising payouts. So very reliable income stock, AAA credit rating. We give its dividend a 99 dividend safety score, indicating a very, very low risk of a dividend cut. You're getting about a 3.2% yield today. The dividend was last hiked by 4% back in April. And the stock has had lower volatility compared to the broader market, a beta value of 0.5. Now, the valuation tool, clicking in here, what you're seeing here is a chart going back 20 years showing Johnson & Johnson's share price represented by this gray line, and this blue band is the price you would expect Johnson & Johnson to trade at if shares traded 10% above or below the stock's 5-year average dividend yield. If you think back to that regression analysis I talked about, J&J's share price and dividend have marched in a fairly predictable pattern for more than 2 decades. We think the 5-year average dividend yield has done a good job over time of capturing that relationship for most stocks. From this perspective, J&J's price of about $156 today sits below its expected price of $164 to $200. You can see that the dividend has kept marching higher in recent years as those blue expected price bands have ticked up when the dividend gets raised, but J&J's stock price in gray has kind of stagnated to even declined over the last few years. I won't get into all the reasons for that, but we don't think they really have any bearing on the company's long-term outlook or would dictate a reason for the company not kind of trading as it usually has in the past. So it's important to say too that when it comes to valuation, I'm a buy and hold conservative investor. I like to own quality companies, so I'm not too fussy about whether they trade below their expected price band or inside of it. My main goal is to avoid risk. That means avoid overpaying for a stock that looks quite overvalued compared to what you would expect. One example of that in recent years is Home Depot. So a giant home improvement retailer, a very safe dividend, solid track record of dividend growth, about double the rate of J&J the last 5 and 20 years. However, when you think about the pandemic, Home Depot was one of those stores that was allowed to stay open. They were deemed to be an essential retailer. So the market initially freaked out in 2020. Even though business was booming for Home Depot, the stock got sold off and looked way undervalued. And then the opposite happened as housebound consumers were, repainting, decorating, putting in home offices, snapping up all sorts of goods while they were stuck at home. Demand just boomed for Home Depot. You can see that in the company's sales growth, 20% and 15%, kind of more than doubling the historical norm as sales really ticked up during the pandemic. And investors, kind of bought into this story. This was the new normal. And it's true that spending is much higher than it was. And it probably is a higher baseline of home improvement spending, but not as good as the market was pricing in. You can kind of see that it took the dividend several years to kind of grow into that $400 price that the market had sped quickly to during the pandemic. And again, the price and dividends follow each other. And in this case, during that time it took for the dividend to kind of catch up to the price actually came crashing back down. It almost got cut in half in 2022 when the Fed started cranking up rates and investors realized that the outlook might not be quite as juicy as they thought it was about a year ago. So this is an example of when this tool would have really helped you kind of avoid risk and say, hey, this is a great company, a great business I'd like to own, but I might get a better chance to own it, or I'm going to have to wait a while for its value to kind of catch up with where the price is. Now, that being said, there are some cases where the dividend isn't the best indicator of value. So you can see if you click here, you can look at this chart based on earnings, the P ratio, or the stock's dividend yield. And I'll give you one example where earnings can be a better metric to look at. So Chubb is a P&C insurer. Warren Buffett has actually been buying up some of the shares in this company. Great business, great track record of dividends, profitability, over 120 years of safe dividends actually for this business. However, Chubb has been kind of stingy with its dividend lately. So you can see 10 years ago, the company was pretty reliably paying out about 25 to 30% of its earnings as a dividend. But the last few years, Chubb's dividend has hardly grown while its earnings have continued to soar. So in this case, if you were just looking at that price to dividend chart, you'd kind of see the dividends slowing down quite a bit while the price continues to do quite well, and the company's earnings have continued to do quite well. So when you see a big change in the payout ratio, that can kind of make this dividend yield indicator a little less reliable, and earnings can become a better measure. And you can see here, looking at, again, Chubb's 5-year average P ratio driving that blue expected price band, this has been a much more solid way to kind of track the stock's reasonable guess of intrinsic value. So you can see that Chubb kind of stagnated here in 2023. Dividends, again, were kind of out of favor. Investors were chasing a lot of growth stocks. AI was big. But Chubb's earnings kept ticking up, and that expected price band kept rising, and now we can see that its price has been catching up. I think Warren Buffett might have actually been trying to buy the stock here. So we've gone through all of the companies in our coverage universe to kind of flag which of these two methods we prefer for value. And some of the differences are quite obvious. I'll show you a couple more here. Chevron is another Warren Buffett stock in the energy space, one of the oil majors. And this is a fun one to look at. During the pandemic, oil prices temporarily flipped negative. Chevron stock was yielding almost 10%. We kept a safe dividend safety score on the company during this time. It was definitely an uncomfortable period, but we kind of looked at Chevron's balance sheet strength and thought they had several years of time they could sustain the dividend until they'd really be under pressure. And if you kind of look at this chart here, the one thing I want to point out again with the earnings versus the dividends, if you're just looking at Chevron trying to evaluate using like a P ratio, the earnings are all over the place because the price of oil and gas drives profits, and the company lost money in 2020. That didn't mean it was a horrible business, not worth anything. It's just there's so much noise in the earnings that the dividend is a much more reasonable buoy of the company's earnings power over time. It's much more stable. And we can see that here. So in 2014 and 15, if you recall, there was a big oil price war globally. Chevron got crushed, but that dividend held steady, and the company looked quite undervalued. And then, of course, during the pandemic here in 2020, you can see the price of Chevron approached $50 a share, which is almost just a third of what its expected price was based on that dividend. Again, assuming that the long-term outlook really hadn't changed for the company, which we didn't think it had. And then, of course, prices eventually caught back up when the market stopped freaking out and realized, okay, the future is not that bleak. And then kind of got overextended here in 2022, and there was a shortage of oil and everything was kind of booming. And now we're back in that fairly valued range. So another example where the dividend is just such a great indicator of a company, again, a mature business, not much is changing with its growth profile or long-term outlook. It's a good indicator of just what shares should be worth and can really help you get out of this cycle of, all right, the price is down. Should I only buy if it's by a 52-week low? It's a classic Warren Buffett quote, price is what you pay, value is what you get. Having a tool like this can really help answer that question. Now, that being said, there are exceptions. So if you're just looking at a low quality business that's not in good financial health, that's facing a bleaker future, hopefully it'll have an unsafe or a very unsafe dividend safety score to kind of cue you in. But if you didn't have that, like Walgreens is a good example here. This is a fallen dividend aristocrat. They cut the dividend at the start of this year. If you had been looking at, the stock's P ratio or the dividend yield over time, you would have said, oh, wow, the shares look really cheap here in 2018, 2019, 2020, 2021. But that proved to be an illusion, right? Because the company's profits came under a bunch more pressure. They took on a lot of debt. They ended up having to cut the dividend here. We think they should cut it again or even suspend it. We'll see if they do. But it's very important to keep in mind business quality, dividend safety, and what the long-term outlook is. It's the old Yogi Berra quote, right? The predictions are hard to make, especially about the future. So trying to stick with stocks that are stable, executing well, growing their earnings, growing their sales, maintaining healthy balance sheets, like some of the examples I showed you, is really important when you're looking at any valuation indicator, because a cheap stock that's facing a diminishing future and straining financial health usually finds a way to get a lot cheaper, and that has certainly been the case with Walgreens here. So that's a look at this valuation tool. You're welcome to check it out. We do offer a completely free 2-week trial. Gives you access to everything on the site if you want to play around with it. You can also have these metrics available in your portfolio, which is pretty fun. You can see here in this portfolio I put together for an earlier video I did. There's a bunch of columns you can pick from. And here I have valuation as one of those columns. So you can sort on the metric and really easily kind of jump in. Here's realty income to look and see, okay, how's the price look compared to the expected price? Giving you a really simple to understand framework, not rooted in a bunch of assumptions and sensitivities like a discounted cash flow analysis or even a dividend discount model. But what's great about it too is there's no hindsight bias or back testing here. Like what you see is what you would have seen back then. So with realty income, for example, in 2016, this forward price to AFFO ratio, it's basically the P ratio for REITs. This is what you would have seen back then based on the analyst estimates that existed for future earnings and based on the 5-year average multiple the stock traded at that time. We're not applying the 5-year average from this whole window all the way back. We're giving you what you would have known at that point in time. So it's a good way to kind of see, hey, did this valuation method actually work pretty well for the stock? Is there something else I should consider instead? You can also see some of the underlying data here, again, with kind of the 5-year charts of these averages, the 52-week price range, and how the stock trades compared to the sector average. There's also a bunch of financials you can look at with explanations to make it easy to understand what you're trying to get from this, including levels that we like to see for these different indicators. This can help you avoid the Walgreens out there and just make sure that, hey, nothing seems to really be changing with this business. Like in Realty Income's case, shares look somewhat cheap today. And if you go to the financials, you can see the payout ratio is 75%, the lowest it's been in a decade. Dividend looks pretty safe from that perspective. Coming down here, this measure of leverage ratio, net debt to EBITDA. You can read more about it, but it's also kind of near its average over the last decade, so the balance sheet hasn't really changed a whole lot. Analysts are predicting 4% cash flow per share growth in the year ahead. That's a good sign as well. So interest rates are definitely a factor for this type of business too. But that's one way to kind of do a quick, even just like a 2-minute diligence on a company to hopefully gain more conviction and make, at the end of the day, a much better informed decision about what to do instead of just acting on emotions. So I hope you found this video helpful. Thank you for watching it. It would really help me out and support me if you considered liking the video, leaving a comment, or even subscribing to our channel. I try to share about 3 or 4 videos every month on analyzing dividend stocks and funds and sharing just different types of income investing tips. So thanks again for watching, and I hope to catch you next time.